So is active management worth it? I mean, should you pay for a fund manager?
The reality is that fees are going down in the investment world at the moment. And that's because you've got the rise of passive where people perceive that you can't be wrong because you're just tracking indices. You can be wrong, but let's put that aside. It is cheap and it is beloved by investment consultants because it is this mixture of performing quite well over the last few years because of the abnormalities of markets and the structures of them. It's cheap and it tracks indices, so you can't be wrong at a certain level. And so what all of this is doing is putting pressure on active manager fees, which are coming down. Actually, what I think the big trend should be, though, is trying to focus on whether active managers are truly active or not, so-called active-active. Because I think that the structure of markets today really favour active managers, people who are properly active, who are looking for interesting individual shares or interesting macro themes around the world in order to bias and tilt their portfolios. The trouble is too many active managers have tacked too close to the passive style of management, and I think they're not justifying their fees at all. So all I would say to external investors is take a look at whether your manager, if you are putting your money with external asset managers, are they really being active or not? And if they're not, then probably they're not justifying their fees. But I think that active managers do justify their fees and will add value above and beyond that.
If you're in this area, do you think finding a star alpha producing manager with a track record is a difficult process? What advice would you give?
It is a difficult process to find somebody who consistently has outperformed over a long period of time, because markets change and people change too. And certainly my experience is that strong performing managers, guess what? They become very popular. The demands on their time go up and up. They may get stuck in a whole load of boring meetings like I used to, and consequently that edge which they created, which was based actually on hard work and an ability to keep on opening up interesting investment opportunities, may actually be taken away from them, let alone if market structures change and things like that. But I strongly believe that proper active managers can be found, people who are savvy, intelligent, have exhibited good performance over a long period of time, and are actually hopefully strong-minded enough to say, look, I don't want to get involved in the politics or the unbelievable meeting structures, and have managerial teams that actually allow them to do that. If you find that, then there is no reason why you can't find a good active manager for your money.
And if you find a good active manager, is it worth paying commissions in exchange for managing the money?
I think the reality is yes, because so long as you're able to justify that any payments, any accumulated fees or whatever are still allowing that investment to outperform versus alternatives such as the dreaded passive solutions or whatever, then I think you can justify that, yes.
What's a fair fee?
So, to my mind, it used to be that a fair fee for a properly active manager in the mutual fund long-only world was a little above 1%, and the hedge fund world famously was the 2 and 20 model. The reality is today, I think it's closer to half that level on both sides. Now, to me, that's good value for money, but reflects the fact that you can buy passive solutions, which I don't like, but they're out there, for just a handful of basis points.
And how much do investors lose in charges and management fees?
I think particularly for the non-active active managers, i.e. those that tack very close to the index but charge an active management fee for it, you can have total expense ratios way above 1%, which unfortunately, given they haven't got the investment structure and backdrop to allow them to outperform by more than that, you're just not going to be making money versus, or you're almost guaranteed not to be making money versus a passive equivalent. So I think people should always look at total expense ratios and the like, and I think they'll be shocked by how high they are, and in many cases way above 1%.
The most commonly quoted cost for a fund is the annual management charge, but it doesn't necessarily reflect the full cost of investing.
No.
Just comment on that.
So you need to look at total expense ratios, and what does that include which an annual management charge on its own doesn't? So obviously it does include the management charge by definition, but there are so many other things required to manage a fund or involved in a fund. For example, trading. If you're buying and selling shares, then that is not costless, that costs money, and the cost of that share trading is a burden on the fund. Because let's say you buy and sell something, the commission for that will be deducted from the fund's net asset value. So you need to look at the cost of that. Then there's all the other costs, underlying costs in fund management, platform fee costs, and other things such as understanding of structures and fees and reports, annual reports, and sending all of those out and the like. If you look at the total expense ratio, all of those are included, hence its name. And that's much, much more than the total headline annual management fee. So I would always look at the TER. And actually, to be fair, the regulators have induced a world now where the TERs are not difficult to find, and consequently they provide a lot of useful information for investors.
So how do you go about choosing a financial advisor?
So you can certainly look at cost. Things like total expense ratios and other related fee costs certainly can be a driver and can be important, but it's not everything. Because let's face it, if you only bought stuff that was cheap, in the investment world you'd always say, well, let's just buy the passive solution and not buy active at all. But there's so much more to it. Because if I look at the investment world today and the global backdrop, I strongly believe that active management is going to have a very strong next 5 years versus the last 5 years. And therefore to choose the cheapest solution may mean you're missing out on that opportunity completely. So I think far more important is understanding the fees, and second, understanding whether your financial advisor or chosen fund manager can justify those fees based on, yes, some element of history, but also importantly, have they got the right mindset, the right method of operation to actually capture the opportunities going forward. Because there's no point in fighting yesterday's battles, you could be fighting tomorrow's. And in the investment world, that means, I think, a global outlook, an appreciation that you've got to be looking for proper active opportunities, and third, offering value for money and strong communication. You get all of those aspects together, and I think you're on to potentially a winner.